Registrations are now open for our ACCA Performance Management exam course. Get access to our comprehensive playlist of over 46 hours of content, including concept videos covering the entire syllabus, exam videos explaining how those concepts are tested in the exam, and question videos to help you with exam practice. Subscribe to one of our packages. The smallest package, for $10, you get access to the entire course for 7 days, or you can subscribe to one of our longer term packages. For more information, check out the links in the description below. And now on to the video. Right, so let's talk about materials price variance. So materials price variance looks at the cost component of the raw materials cost, okay? So raw materials are usually purchased in terms of kilograms if there's something solid, or liters if there's something liquid, etc., right? They're not in terms of units, obviously. Units are our finished goods. Raw materials are kgs, liters, etc. So the material price variance will look at the cost per kg or the cost per liter at which we're buying the raw material. So let's say our standard is that we buy at $2 per kg, but for some reason we might end up buying at $3 per kg on average, or $1.5 per kg on average. So this variation in the cost per kg or the cost per liter that we're paying, that's what the material price variance looks at, okay? So the way we calculate the materials price variance, we take the standard cost per kg, from it we subtract the actual cost per kg, and we multiply that by the actual quantity purchased in terms of kgs. Now we're using kg as a reference point. It could be liters or whatever the raw materials are in, grams, whatever, right? And if we calculate the materials price variance in this order, if we get a positive number, that's a favorable materials price variance. If we get a negative number, it's an adverse materials price variance. So for example, let's say that the standard cost is $2 per kg of plastic for a plastic bottle manufacturer, okay? Over the next week, the manufacturer buys 3,000 kg of plastic at a total cost of 7,500. So these are the actual numbers. What is the materials price variance? So we take the standard cost per kg, which is $2 in this case, and then we find the actual cost per kg. So we bought a total of 3,000 kg at a total cost of 7,500. Dividing 7,500 by 3,000 will give us $2.5 per kg, and we multiply that by the actual quantity purchased, which was 3,000 kg. So we multiply that by 3,000, and the end result is an adverse variance of $1,500. Why? Because we said we should buy at an average cost of $2 per kg. We ended up buying at an average cost of $2.5 per kg. Since we paid more than that was expected, and that's a bad thing, it's a cost, that's why the variance was adverse, okay? Now, it's just one thing to know whether the variance was favorable or adverse, but that's not the gist of it. As an analyst, we need to look deeper. We don't just look at whether the variance is favorable or adverse, we need to look at why it was favorable or adverse, right? And the table below highlights some of the reasons why a variance could be favorable or adverse, okay? Favorable meaning that the actual cost we paid was less than the standard cost we expected to pay, and adverse meaning that the actual cost we paid was more than the standard cost we expected to pay, like in our example above, okay? So the reason for our example above, this adverse variance, could be there might have been unexpected inflation in the market causing the price of plastic to increase. Maybe the manager negotiated poorly with suppliers. Initially he had agreed $2 with them, but then the suppliers pushed him and he agreed to pay more than that, right? Maybe he made rushed purchases, and because of that, the short-term notice, he had to pay a higher price to get the materials quickly. Or maybe he actually bought higher quality plastic, and because the quality was higher, he had to pay a higher price for it as well. On the flip side, the opposite would be true. If he paid, let's say instead of $2, he paid $1.5 per kg of plastic. Maybe there was unexpected deflation in the market. The prices of plastic were falling. The supply of plastic had increased, causing the price to go down, right? Maybe he negotiated well and was able to get some discounts. Maybe he bought in bulk and got some discounts, right? Or maybe he just purchased lower quality plastic which was cheaper, and therefore he was able to save on cost. But here's an important thing to note, right? A favorable variance does not necessarily mean it's a good thing for the company, and adverse variance does not necessarily mean it's a bad thing. Why? Think about these points. If you're buying lower quality material, yes, you're going to save on cost, but what's going to happen to your final product, the final bottle that you make out of that plastic? Obviously, that's going to be of lower quality as well, and it might the customers might become unhappy, right? You might have to reduce your own prices. Likewise, buying a higher quality material is not a bad thing. Even if you have to pay more for it, it means your end product will be of higher quality as well. So it's not black and white in that we purely look at an adverse variance as a bad thing or a favorable variance as a good thing. We need to dig deeper, analyze, and understand why it's favorable or adverse before we can make that conclusion. So that's the materials price variance.